Historically, there's been a fairly reliable, you never want to confuse correlation with causation, but the notion of an inverted yield curve, that when short-term rates are higher than long-term rates,
Right.
historically that has sort of preceded a recession. It became sort of this indicator, leading indicator perhaps. So we've actually had an inverted yield curve for over a year now. And most people are assuming that no, in fact, we're not going to have a recession. So what are your thoughts on why the inverted yield curve historically has been a perhaps indicator, and why this time it looks like it's going to miss the mark? What are your
Yeah,
thoughts?
it's really interesting, and the inverted yield curve has been a very good indicator, highly correlated with recession since the end of World War II, right? It's been a very, very good predictor. When it's inverted for more than a few months, it has a very high batting average in terms of predicting recessions, very high. It might be at 100%, right? It might predict all of them. And we've had a inverted yield curve now, whether you're looking at the 2 to 10 or the 3 months to 10 year Treasury bond. It's been inverted for, as you say, for a long time. And so the historical correlation, if you applied it to this experience, would suggest that we should already be in recession, right? And one thing I've learned, as soon as somebody says this time it's different, you have to take what they're going to say next with a grain of salt. So, but nevertheless, I will say that this time it just seems to be different. That the COVID recession, the coming out of COVID, the COVID recovery, the once in a century pandemic, the supply chain issues significant supply chain issues that we had that are resolved, all the problems that the economy has had in the last couple of years is just really, really different. And then the other thing is, I think the Federal Reserve this time it rose rates very, very quickly. It increased rates very, very quickly at the fastest pace since the early 80s. But it raised them from a very, very low rates, right? The federal funds target rate was basically zero. We had negative real interest rates. And they didn't they didn't overcompensate, it appears. And so the ability of the Fed to engineer soft landing seems more likely this time than it has in the past. The fat lady hasn't sung yet, so we don't know what the next year will hold. Is there a big difference between growth that's just above zero and growth that's just below zero? If you're working, at a small business and you're worried about having enough revenue to meet costs and so on, having the business to be viable, there may not be a big difference between growth at 0.5 versus growth at minus 0.5 in terms of the impact on the people who work for that business. But nevertheless, I think it's more likely than not, based on the forecast, based on all the reporting, based on the data, it seems it's more likely than not that we're going to have a soft landing. But it doesn't mean that we're going to have a rosy picture. It means that could mean that growth will slow, and but the economy will not contract.